Welcome students to another lecture in the series. Let us continue with the further provisions of income from house property. Let us see the second case in continuation with the from the previous video lecture. There we studied section 23 subsection 1 and now we will study section 23 subsection 2, that is property occupied by the owner. In these two cases, the NAV shall be considered to be nil when the property is occupied by the owner himself for his own residential purpose throughout the previous year, or if the property actually cannot be occupied by the owner because due to his employment, business or profession, and he's residing in some other city or place in a building which is not belonging to him. But the NAV shall be considered to be nil only if the property is not actually let out during the whole year, means that property should not be put on rent and no other benefit is being derived from that particular property. So in respect of such house, the only deduction which is permissible against this nil income is interest on borrowed capital, which can be up to rupees 30,000 or 2 lakh as the case may be. We have explained this before, even the deductions from income under head house property. No other deduction, that is municipal deduction or standard deduction, is permissible from that self-occupied house. We cannot give any further deduction in this. Then deemed let out properties, if there are more than one self-occupied houses, quite possible, no? So then in that case, the SSC may exercise an option to treat one of the houses as self-occupied. The other house will be deemed to be let out and the annual value of such house will be calculated, and as is in the case of let out property. So SSC in this case should exercise his option in such a manner that his taxable income is minimum. Obviously, he will choose the house accordingly. Let us have a look to this using a question. A person Y has two houses, both of which are self-occupied. The particulars of these houses are like municipal value is given to us. One is having 70,000, other is 1 lakh. Fair rental value is 82,000 and 1 lakh 30,000. Then standard rent is not quoted here and it is 1 lakh 10,000. For the second house, municipal taxes 7,000 which are paid during the year and 10,000 which is being paid for house 2 during the year. We need to suggest which house should be opted by this person Y to be assessed as self-occupied. Let us see the calculations. See, suppose in that case, first of all, we need to assume that suppose both the houses are let out. In that case, let us see the gross annual value first of all. For the first house, why it is considered as 80,000? Because municipal value of fair rent, whichever is higher, is considered. So 82,000 would be considered for this house and 1,30,000 would be considered for this house. But it cannot go beyond the standard rent, which is 1,10,000. So it is 82,000 and it is 1,10,000. Then further we need to subtract the municipal taxes that we have paid and obtain the NAV, that is 75,000 here in this case and 1 lakh in this case. And then further we are supposed to provide standard deduction at the rate 30%, which covers all the expenses further related to the like tenancy or so. So that comes out to be 22,500 and in this case 30,000, that is 30% of 1 lakh rupees. And finally we are able to obtain the NAV. So in this case, obviously the second house is giving you the more income of the rupees 75,000. So more tax would be payable. So in that case, because the income from house 2 is more, so it should be considered to be self-occupied so that the taxable income would be minimum. The person is supposed to pay less tax in that case. In continuation of the previous provisions, let us continue with the third point, means where let out and self-occupied property case. Suppose partly let out and partly self-occupied property, means some portion of the property is being self-occupied for the residents for the whole year and the other portion is being let out for the whole year. Then in that case, the NAV will be calculated in this manner. First of all, from the full annual value of the house, the proportionate annual value for the self-occupied portion for the whole year shall be deducted. Means that suppose half of the house is self-occupied, then rest amount would be accordingly treated. And the balance would be treated as annual value for that let out portion. The property let out for any part of the previous year and self-occupied for the remaining part of the year, the valuation of such property shall be done as if it is being let out for the whole previous year. Actual rent is taken only for the period it is actually let out, while expected rent is always taken for the entire previous year, and the gross annual value shall be higher of these of two values which are given to us. Thank you. We will continue with more of the numericals and practice in the next lecture. Till then, you practice well. Take care. Bye-bye.